Right now, if you ask two of Australia's biggest banks what's about to happen to Melbourne property prices, you'll get two completely opposite answers. One bank is telling its clients to expect growth this year. Another bank, looking at the exact same interest rate, the exact same economy, is warning of a fall approaching 4%. Same city, same week, same data, and yet completely different conclusions. That alone should tell you something strange is going on in this market right now. But here's the part that makes it even stranger. Melbourne just added more new residents than any other capital city in the country. More than Sydney, more than Brisbane, more than Perth. And during that exact same period, prices in this city kept sliding. More people usually means more competition for homes, which usually means higher prices. That's basic economics. So why isn't it happening here? Something doesn't add up, and today we're going to pull this whole thing apart piece by piece, using the actual numbers, not headlines, not guesses. And by the end of this, you'll understand exactly why Melbourne has become the most confusing property market in Australia right now, and what that confusion might actually mean for you. Hey guys, Daniel here. Welcome back to Daniel Reports. Now, before we get into the numbers, I want to be upfront with you about something. I'm not here to tell you Melbourne is about to boom, and I'm not here to tell you it's about to crash either. Anyone doing that on YouTube right now is probably just trying to get a reaction out of you. What I want to do is actually walk you through why the smartest banks in the country can't agree on this city, because once you understand that disagreement, you'll be in a much better position than most people watching the news. If you're new here, this is exactly the kind of thing I cover every single week: property, the economy, government policy, basically anything that quietly affects your bank account without you noticing. So if that sounds useful to you, do me a favor and hit subscribe now before you forget. It genuinely helps this channel keep going, and let's get into it properly. So let's start with where things actually stand today. As of the middle of this year, the median dwelling value across Melbourne sits at just over $800,000. Houses alone are sitting closer to $950,000. Now here's the thing, that number has actually been falling, not by a huge amount month to month, but consistently. Over the last quarter alone, house values dropped by more than 3%. And get this, prices are now around 4% below where they peaked back in 2022. So if you've been hearing that Melbourne prices are still climbing every year, that story is a little out of date. Here's a number that might surprise you even more. Melbourne houses right now are sitting over $600,000 cheaper than the median house in Sydney. $600,000. That's not a small gap. That's basically the price of an entire second property in some parts of this country. Now, is that a warning sign that something's wrong with Melbourne? Or is that actually the biggest opportunity sitting in plain sight? Stick around, because by the end of this, you'll have a much clearer answer than you do right now. Let's talk about why prices have actually been sliding, because this is where most people get the story wrong. Earlier this year, the Reserve Bank hiked interest rates 3 separate times. That basically wiped out every single rate cut we got throughout 2025. Think about it like this. Imagine you've been slowly filling up your car with fuel over several months, getting ready for a road trip, and then someone comes along and drains the tank right back down before you even leave the driveway. That's essentially what happened to borrowing power in this country this year. People who could afford a certain loan in January suddenly couldn't afford nearly as much by the middle of the year, and when people can borrow less, they simply can't bid as high at auction. That's it. That's the whole mechanism. It's not complicated. It's just maths. And look, here's something I'll say from my own experience watching this market for years now. Every single time rates get hiked, there's this weird lag where sellers don't want to believe the market has actually shifted yet. They still think their place is worth what the neighbor sold for 18 months ago. That mismatch is exactly why you're now seeing homes sit on the market for over a month before they sell, and listings piling up nearly 18% higher than this time last year. Sellers are only just starting to catch up to reality. Now here's where things get genuinely confusing, and I promise this is the part that ties the whole video together. If rates going up explains falling prices, why on earth are the big banks still fighting about where this market goes next? Commonwealth Bank reckons Melbourne prices will actually rise about 1% this year. Westpac, on the other hand, reckons prices will fall closer to 4%. NAB sits somewhere in the middle with a small decline, and ANZ lands somewhere between the two as well. That's not a small disagreement. That's a 5 percentage point gap between two of the largest banks in this country, both looking at the exact same Reserve Bank decision. So how do professional economists staring at identical data end up with such different conclusions? Honestly, it comes down to what they think happens next. The banks predicting growth are betting that the Reserve Bank is basically done hiking rates for now, and that Melbourne's relative affordability compared to Sydney starts pulling buyers back in. The banks predicting a fall are worried about something else entirely: unemployment. And that's genuinely the number I'd be watching more closely than anything else right now. The Reserve Bank's own forecasts show unemployment climbing toward 4.5% by the end of this year, and edging even higher after that. Now that might not sound like a dramatic jump, but here's why it actually matters more than another rate hike would. If you lose your job, or you're suddenly worried you might, you don't go to an open home this weekend. Doesn't matter what interest rates are doing. Fear of losing your income beats almost every other factor when it comes to whether someone actually pulls the trigger on a 6 or 7 figure purchase. That's not something you'll find in a spreadsheet. but anyone who's ever bought a house under financial pressure knows exactly what I mean. All right, let's tackle that population puzzle I mentioned right at the start, because this one genuinely trips people up. Melbourne added just over 105,000 new residents in the last financial year alone. That's the biggest increase of any capital city in the entire country. And yet prices kept softening at the same time. On the surface, that looks completely backwards. But here's the part almost nobody talks about. At the very same time all these new residents were arriving from overseas, a separate group of existing Melbourne locals were quietly packing up and heading interstate. Around 8,500 people left Melbourne for places like Brisbane and Perth, chasing cheaper housing and a lower cost of living. So what you're actually looking at isn't one story, it's two stories happening at once. International arrivals are propping the population number up, while affordability pressure is pushing long-term locals out the back door. It's a bit like a bathtub where the tap is running fast, but there's also a decent-sized hole letting water out the bottom. The tub still looks like it's filling up if you only glance at it quickly, but the actual pressure inside tells a very different story. Now here's a puzzle that honestly took me a while to properly get my head around too. Rental vacancy across Melbourne is sitting at just 1.5%. That is genuinely tight. If you've tried renting in this city recently, you already know exactly what I'm talking about. Queues out the door at inspections, 20 applications for one 2-bedroom unit. It's brutal out there. So here's the obvious question. If renters are this scarce, why aren't purchase prices going through the roof as well? The answer is that renting and buying have basically become two separate battles right now, fought by two different groups of people. The people desperately competing for rentals largely can't afford to buy at these interest rates, so they're stuck fighting it out in the rental pool instead. Meanwhile, the people who can still afford to buy are being far more cautious, because nobody wants to purchase today and watch the bank down the road predict another 4% fall tomorrow. So you end up with intense pressure building up on one side of the market and hesitation building up on the other, and the two barely interact with each other at all. Quick pause here, because I know some of you are further into your buying journey and might be wondering about policy changes. So let's cover something genuinely useful rather than something designed to scare you. The federal government recently extended the ban on foreign buyers purchasing established homes. That ban now runs through to mid-2029 instead of ending next year. Now I know rule changes like this can sound alarming, like something's about to get harder for you, but actually this one mostly protects local buyers because it keeps existing housing stock available for Australians rather than overseas investors competing for the same established homes. On top of that, Victoria has actually extended its stamp duty concession on off-the-plan apartments and townhouses right through to April 2027, which genuinely widens the pool of realistic options if you're a first home buyer trying to get into this market without needing a 6-figure deposit sitting in the bank. So if anything, the direction of policy right now is quietly working in favour of everyday buyers, not against them. It just doesn't get the headlines that a scary interest rate story does. Let's move on to something that most citywide headlines completely gloss over, and honestly this might be the single most important thing in this entire video. Melbourne isn't really one property market. It behaves like at least 3 or 4 separate markets stitched together under one median number. Houses across the city are down over 1% for the year. Units, on the other hand, are basically flat, down only around 1/5 of 1%. That's a genuinely different story hiding inside the same headline stat. And zoom into individual suburbs and it gets even more interesting. Coburg, for example, posted growth of nearly 6% over the past year. Out in Melbourne's outer west, the Wyndham Corridor grew more than 4%, largely driven by new infrastructure and families chasing more affordable land. Meanwhile, some of the ultra-premium inner east suburbs, the $2 million plus streets, have actually cooled the most, simply because that's where borrowing capacity gets stretched to its absolute limit the moment rates rise. So when someone tells you Melbourne prices fell this year, ask them which Melbourne they're actually talking about, because the outer growth corridors and the blue chip inner suburbs are living through almost opposite years right now. Let's bring in a bit of history for a second, because this Sydney gap I mentioned earlier isn't actually new. We've seen this exact price gap open up between Melbourne and Sydney before, and historically it hasn't stayed this wide forever. It tends to close over time as buyers priced out of Sydney start looking seriously at Melbourne instead. What's genuinely different this time is the population trajectory sitting underneath it all. Melbourne is on track to actually overtake Sydney as Australia's biggest city within roughly the next 6 years. Now that shift alone doesn't guarantee prices rise faster here, but it does tell you where long-term underlying demand is quietly heading, regardless of what happens over the next 12 months. So here's my honest take for whatever it's worth, and just to be clear, this is genuinely my own view, not something any bank or real estate agency is paying me to say. I don't think Melbourne is about to crash the way some of the more dramatic headlines are suggesting, but I also don't think we're about to see a sudden dramatic boom either. What I think we're actually watching is a genuine reset, a market slowly working out its real honest price after 2 years of correction, before it can properly build any real momentum again. And realistically, the truth almost certainly lands somewhere between Commonwealth Bank's optimism and Westpac's more cautious call, which, if you think about it, is usually where these things actually end up. So what does all of this actually mean, depending on where you personally sit right now? If you're a first home buyer, Melbourne remains genuinely more affordable than Sydney and Brisbane at the moment, and that off-the-plan stamp duty concession we just covered is honestly worth looking into properly before you rule anything out. If you already own a home here and you're feeling nervous watching these headlines, remember a single monthly figure showing a small decline doesn't automatically mean your own property has lost serious value. Suburb level performance genuinely varies enormously right now, as we just walk through together. And if you're looking at this as an investor, you need to get clear on which game you're actually playing. Are you chasing rental yield? Because units are clearly holding up far better right now. Or are you chasing long-term capital growth? Because that story still leans more toward houses in the right growth corridors. Trying to chase both at once in this particular market is honestly how a lot of people end up disappointed. Before I wrap up, I'd genuinely love to know what you make of all this. Do you think Melbourne is finally getting close to turning a corner, or do you think this correction still has further to run? Drop a comment below and let me know. I read basically every single one, and I'll often reply directly if you've got a specific suburb or situation you're curious about. And if this video actually helped clear things up for you, do me a favor and share it with someone you know who's currently trying to figure out whether now is the right time to buy in Melbourne. It genuinely helps more than you'd think, and it helps this channel keep putting out research like this every week. I'm Daniel, this is Daniel Reports. I cover property, the economy, and government policy every single week, so you can stay ahead of the trends that actually affect your money and the people you care about. Thanks so much for watching, and I'll catch you in the next one.